Hello, welcome. I'm Andrew from Beely Capital, and today we're just going to go over a little bit of Excel backup to complement an analysis I did. So if you're unaware, this is Substack, beelycapital.substack.com. Recently, so a little over a week ago, did a write-up on Adyen, which was an interesting company. Hopefully people appreciated. And so today I just want to share a little bit of how I reached some of the conclusions in the piece. In particular, when I talk about the valuation, I calculated some free cash flow, enterprise value, and then I did a reverse discounted cash flow. And there are a lot of potential assumptions embedded in there. And so I wanted to take a little while to walk you through some of the research work that I'd done and help you understand the assumptions, and then also provide some of the backup files so that if you want to make different assumptions and play around with things, you can make your own projections and see what sort of results that looks like. All right, so to start with, I want to just explain this, which is one of my favorite templates, and I will be sharing this. So just a heads up, these are probably all Bloomberg enabled, close to all Bloomberg enabled. And so if you do not have Bloomberg, which is expensive software that I would say is mostly used by professionals, it's kind of in the 25K a year ballpark, then these formulas are not going to work for you. You can see what they're supposed to be, and there are kind of other data sources that can oftentimes get these data points for you. Unfortunately, it's just not as smooth. So if you know of an effective way to get lots of fundamental and stock related data into Excel via some sort of plugin that's cheaper than Bloomberg, please let me know, because Bloomberg's expensive, but for what it does, it's really kind of top tier, world class. I did a little bit of investment banking, and then I was on the buy side for the past like 7.5 years or so, and I can tell you that Bloomberg is kind of state of the art still. There have been a lot of competitors, but nothing really replicates its breadth of data, features, and then data transparency to the underlying. So with all that out of the way, I want to first walk you through this. FDSO is fully diluted shares outstanding. This is something I learned in my investment banking days and is one of my favorite tools for figuring out, most importantly, how much are you really paying if you look at a stock. Oftentimes people just see some sort of share price, and I don't know when this was last updated. This may be 15 minutes stale, or it may be a few days stale. But people just look at a share price and don't look at how much the actual company costs, and they don't look at what all you're getting or potential other dilution of the company. So this is also very helpful for finding potential shorts. If a company has a lot of dilution, then they oftentimes will end up having to turn those shares into reality, issue those shares. And so at least short term, the kind of supply and demand picture is bad. If there's more supply for the same amount of demand, then the price tends to go down, and that's oftentimes a good short signal. So just a brief refresher. Hopefully most people know what dilution is, but imagine ownership of a company like a pizza cut into different slices. Each share is a slice, and so you have the same amount of pizza, but you can cut it into more and more and more slices. And what you want to know is how many other slices are there out there. If I have one slice, how much pizza am I actually getting? So in this, if I have one share, how much of the company am I actually getting? So for this, we said there are 31.49 million, so everything should be in million by default, shares outstanding as of some date. So this is February 10th, and I got this from their annual report, page 216. I'm just going to navigate to that quickly. I'll need to come up with a better way to do this over time, but we'll do that here for now, and I'm just going to consolidate this Adyen write-up. Actually, I'm going to leave it here so that I can manage some other things to the side. But if we go back for a second, yep, I'm going to come up with a better streaming setup, but that's fine. This said page 216, 2024 annual report. If we go here, 216, let's see how good a job we did this. So it says that this led to 31.485,187 million ordinary shares, which happens to be this amount here. and I think we were just doing that as of February 2nd, 2025. I'm not sure if there was specific language about that or if that's just when this annual report came out and that's what we're basing it on. So to just explain what we're doing quickly, we're starting how many shares are currently outstanding for Adyen. Then we're adding the RSUs, so restricted stock units. And then we're also adding any stock to be issued. So in this instance, we found some options. So just a small number of options. This is about 20,000, because remember, this is all in millions, with a strike of 11 euros a share. So those are very in the money. There's just some basic logic here that says if the price is less, if the strike price is less than the current price or equal to, then the shares are in the money, and the proceeds that the company Adyen will get from insiders or whoever owns these options exercising them is very simple. It's the amount of options you have, 20,000 shares of options or 20,000 options, times the strike, $11. So if you just multiply those two together, this says that you turn out to get about 170,000. Yep. So 170,000 euros, which is obviously not much, and it's just a little bit of stock that would be issued. We automatically assume that any option proceeds would be used to buy back shares at the current price to reduce or net out the dilution. And so this leads to 31.58 fully diluted shares outstanding. I'll include this calculator. It'll all work. I should really make this legend for you guys quickly as well. And I'll try and include this on more of my Excel sheets for you guys. So this is link, same sheet, link, different sheet / workbook, and formula. So these are the primary classifications I use. So hard code, we make that blue. So that lets you know that's something that we're typing in, needs to be adjusted. This is a link, same sheet. So we'll see this link here is to this cell down here, which is a sum of all the potentially dilutive securities that are in the money. Then link different sheet workbook is this red. I think I just tend to use the default red, and then black is for a formula. I will walk you guys through a few Excel shortcuts. I did investment banking before this. I'm a big fan. It makes things a lot faster. One brief aside, if you want to get exact colors, there's a little tool you can get called Instant Eyedropper, and you can have a keyboard shortcut and it'll tell you exactly what color is being used here. I'm not sure how well it does on this. So you can see here 00255, so that's saying it's 100% blue, and 0 on the red and green for the RGB values. It's a little tough with text because the text is so small. And let me just walk you through this keyboard shortcut for a minute. So you hit Alt. This is like a keyboard shortcut from the ribbon. And so then you see all these letters up here. And so you can type different ones, and I guess it times out. So you hit Alt. This, I don't know what led to that, but if you hit Alt and then H, that'll take you to this home ribbon. Then we want FC for font color, and then you can select the colors. You can hit M for more colors. I hit my right arrow to go over one tab, and then you can, if you see these letters are underlined, so you can do Alt R, and that'll get your cursor selecting red. Alt G, blue. So 0 is going to be all black. If you max out the value for one of those RGB fields, that'll give you the color. So I use 255 blue, 128 green. I think this is 255 red, but I'm not sure. It is 255 red, so just the most red possible. And then black is just 000. So it's both automatic, Alt HFC, you can hit A, or we can look under more colors, it's 0000. So that is the legend that we're using for this. Here's the fully diluted shares outstanding. We also wanted to adjust for the cash balance Adyen had, and this part is just slightly tricky. So we're looking at page 194 here because I've already done this work. But if you look at page 194, you'll see the balance sheet. This is for Adyen from their annual report. I think I've already linked it in my Substack piece. And if you look here, you'll see that they have cash and equivalents of 9.965030. which is significantly more than what we had here. So what did we do? We subtracted the 9965.03 because you subtract cash from the market cap to get to enterprise value. I'm kind of taking that for granted, assuming people know that. If you don't, you can look that up online. You can ask a question in the comments, something like that. I'm happy to explain, but I'm mostly going to try to get to useful work and not spend too much time explaining basic finance concepts. But then we're adding back something. What is it that we're adding back? We're adding back the payables to merchants and financial institutions. So Adyen, as a business, processes payments across the internet for a lot of different companies. And one of the things they do is they get the money, they process the payment from your credit card. So I go buy some Nikes online. When I swipe my card, then the bank, Discover or Chase or whomever my credit card is with, sends the money to the merchant. The payment processor is the one that's facilitating this money moving along, and in this instance it would be Adyen. So Adyen has the money that's going to Nike. They also have the money going to Visa, going to the issuing bank, going to money's moving all around, going back to me eventually for rewards, so I get 1% cash back or whatever. It's actually going to the issuing bank and then to me. But Adyen's in charge of kind of orchestrating that entire transaction payment. And so they hold on to a lot of the money, not for very long, but just holding on to that money for a very small amount of time over so many transactions can lead to significant amount of payables. And you'll see this tends to grow over time. This gives Adyen a positive cash flow conversion cycle where they're kind of benefiting from the float. So they have kind of negative net working capital. They keep getting money as their business grows. So they don't have to raise money from outside investors in order to invest more in the business. In fact, as their business grows and scales more, there's more money in the form of this float available for them to invest. Oh no, I realized that I have a problem with my... Oh no, this looks fine here. Okay, maybe. Okay, apologies. I was looking at the wrong thing for a second. I thought that you guys were still stuck on my Excel and not able to see the consolidated balance sheet, which would have made me sad. So we have to subtract this out because basically Adyen's cash balance includes a ton of money that's not really theirs. And so we don't want to give Adyen credit for all that when really they owe most of that cash, about 2/3, on to the merchants and financial institutions that are part of the transactions as well. So that's how we get to the, sorry about this, underlying net cash for them of about 3.3 billion euros, which gives them about a 41.5 billion enterprise value. And then I want to talk about the free cash flow reconciliation quickly. And then I will probably save the reverse DCF for next time because I don't know if anyone's going to watch a 20-minute video, much less a 40-minute video. But let me just walk you through this quickly. So again, going back to the annual report, we're going to have to zoom out. Well, maybe it'll be nice for you guys to be zoomed in here. So we start with the income before income taxes. And you can see I actually did all these numbers off to the side. I wanted to confirm the signs. Sometimes those are confusing, especially on a statement of cash flows, to make sure that you know, like for here, all of these have dashes, and these could be subtracting these numbers, or these could be just kind of bullet points. And it's not always obvious how this is being calculated immediately. But when we just look here, it turns out that they've just added everything up. And so we get to that 1675 spot 18, 1675 spot 18. So they're just adding all these. So these are just bullet points effectively and not an adjustment where they're subtracting. So we can just use all the signs. We don't have to flip them. Sounds basic. It is, but it's also kind of tricky sometimes. So we're starting with the income before income taxes. Technically, for this to be true EBIT, this should be earnings before interest and taxes. But we're doing this here because we're going to back out the interest income, interest expense, finance income, and finance expense. And we see this finance income is a big delta. So they're basically backing out a lot of earnings here, and then they're adding it back here in the finance income received. So that's just a little bit tricky. And I'm aware that my face is kind of blocking the screen, so you can't see everything on this right side. But we'll scroll over there if we need that. I don't think we'll need it too much. So we start with the EBIT, then the other income, 2.953 plus 1889. That's these results. We'll just look at 2024 for now. And so then and to be clear, we are adding all these things in. So we're basically starting with EBIT, which would be before interest and taxes, but the reason why we're including interest here is because they have net interest income. So we want to see how much the entire business is making, and we're going to strip out the extra net interest from cash, basically, in a moment. So when we say EBIT, maybe I'll just make this EBT, earnings before taxes, so that people know a little more clearly. Then we add the D&A, so that's this 55,101 plus depreciation of right-of-use assets, which is mostly going to be depreciation involved in leases. So there's an argument to be made for not adding that back if you think that it shows up as like a lease expense. And they do have lease payments here, and I'm not sure if I remembered to include lease payments or not. So we may want to fix that here as well, which is part of why I'm doing this, to just battle test everything and make sure things make sense. And then we have the stock-based compensation as well. So 34.786. And so what they're doing, to be clear, is they're adding this stock-based compensation back. And I'm a little surprised that I'm doing this because I like expensing stock-based compensation. So I think that I built up to cash here, but then I am not sure if I excluded stock-based comp later on. So we'll see if I got to the correct free cash flow or if I need to tweak this slightly. So we'll get to that in just a second. Now we're going to add up the change in working capital, which is all these things. So 4.674, etc. You can just kind of take my word for it. Hopefully I did this math right. Turns out to be 654 million. So this is the cash from operations that the company got. And then this is the income tax paid, net cash from operations, CapEx, now free cash flow. So here's where I'm backing it out. So this is kind of their cash from operations and net cash from operating activities. And so this is the literal cash the company is getting. However, a lot of this cash is not theirs. This change in working capital is just that float, like we said. So it's when someone pays you money up front, but you owe them the $650 million later on. So obviously that's not sustainable free cash flow. I can't count on people paying me $650 million more than I owe them each year. And certainly that's not my money, so I don't get to count it as profit. So we are looking at the actual cash going into the business, which is great and can help be reinvested by Adyen. So this is the cash they would have available if they needed to finance an acquisition, a big capital expenditure, etc. However, the actual cash that will be available to be distributed to shareholders is the free cash flow here. So for that, we're taking the cash from operating activities after the income taxes paid. So we're just doing cash taxes, not worrying about it too much. It's like a 15% income tax rate here. We're subtracting out stock-based compensation because that's a real expense. Even though it's a non-cash expense, they just issue shares. Those shares are valuable. That's why we're buying shares in the first place. If they weren't valuable, we wouldn't want to buy them. And then, so because of that, we need to act as if that's a real expense. And so if we were paying in cash instead of in shares, we estimate that it would have been about that stock-based compensation expense of 35 million euros. And then we need to strip out the change in working capital, because like we mentioned, that's someone else's money. And finally, we need to subtract capital expenditures. So we've added back depreciation and amortization, and this is a not very capital intensive business, but they're still spending money every year to replace payment processors, to reissue equipment to vendors, to build servers, to all sorts of different things for the business. And so they're going to have to keep spending that much money in the future, or maybe even spend more in order to grow the business. And so that's a real use of cash. So we want to make sure that we're taking that into account. So that's just our rough free cash flow to EV. We have this one in red because it's linking back to our enterprise value right here. So on a 41.5 billion EV, we get 2.21% free cash flow, which is not very high. If you invested $100 in Adyen, right now they would be, and you owned the entire company for $100, it would give you a little more than $2 a year, which is not great, especially in a world where the treasury bills are paying like 4.5%, so $4.50 a year for $100 invested. But what makes Adyen interesting, and we'll get to in the next video, is their growth potential. And so we can look at how much we think Adyen needs to grow in order to justify its current valuation or make it worth even more in the future. Now, the other things we did, we looked at the net interest income here. And so the net interest income ended up being about $350. And so if we want to look at free cash flow excluding the float in cash, we could say, okay, the real free cash flow, excluding any benefits from float and any returns on the cash, is only 568. So that's significantly lower. I don't know what that is about. Okay, 62%. So it's 38% lower. So that's a big difference. What I'm really interested in, though, is I think that it's a sustainable business for Adyen to keep having a float where they get money up front and then they pay money on to the customer, well, to their customers, which are the businesses that are receiving the payments from you and me as the customer. So it's Nike, for instance. But Adyen gives that money on a lag, and so it's reasonable for Adyen to continue to earn money on that float, that money that Adyen holds on to for a little while before they pass it on to Nike or other customers of Adyen's. So, but what I don't want to give them credit for is the interest they're earning on their cash, because they have about $3.2 billion of cash. I'm giving them credit for this cash by just reducing their entire enterprise value, but the full amount of that cash. So I don't want to count any earnings they're getting from this cash, because that would be double counting. I'd be both subtracting it in the denominator and then keeping the proceeds in the numerator. So I'm assuming about a 3.5% earnings rate, which is about in line with their total net interest income, $350, on this total amount, which, as you might remember, was about 9.9, so almost $10 billion, including all the amount that's due to customers. So in effect, I'm saying 2/3 of the cash is not really Adyen's, so we aren't going to give them credit for it on their enterprise value. It's not going to reduce their enterprise value because that's not their cash. However, they do get to the use of that cash during the year, and they get paid money on it, which is fantastic. And so that's a valuable feature of their business. So I'm effectively giving them credit for 2/3 of their net interest income. So 1/3, $115 million, I'm saying, hey, that's earnings on the cash Adyen just has lying around. I'm not going to give them credit for that. But the rest of it, the $235 million, that is a feature, that's profit they earn as a part of their business from their float, and so we're going to include that. And so our free cash flow excludes that excess earnings on cash, and we get to $802 million. This is about 1.93%, which is why I said in my piece, let me pull it up here, I think I used just about these exact numbers. Yep, 41.5, calculate free cash flow is approximately $917 million, 115 is excess, and so we get to the 1.93%. So I haven't updated the price that we're showing here. So I haven't updated the share price. If you update this, it would be slightly different, but the numbers should be directionally the same. So that concludes this video. I might do an explainer at some point of how to actually build a fully diluted shares outstanding calculator if people want, and so on. But in the next video, I'll just show you as a preview, we're going to go through this, which is my reverse DCF, where we'll be looking at what assumptions do we make about the value of Adyen, and how much does Adyen have to grow in order for it to be worth the enterprise value, $41.5 million. So stay tuned for part 2 next time. Thanks.